Indeed, the purpose of this presentation is to talk about the role of reverse mortgages in retirement income planning. And in that regard, as Betty mentioned, I'm the RICP program director, and my job title is Professor of Retirement Income. So I feel it's my responsibility to make sure that I talk about all the different tools available for retirees. Now, reverse mortgages wasn't really on the top of mind as something I need to get to sooner rather than later necessarily. But several years back, John Salter from Texas Tech University invited me to one of the meetings for the Funding Longevity Task Force, which is now the Academy for Housing Wealth, and sent me a stack of articles about reverse mortgages. And as I read those articles on the plane to the meeting, I really became interested. This was a fascinating topic, and reverse mortgages can be used in many different ways in retirement income. And so in starting to write about that and to replicate some of the past research in that area, I ended up writing the first of several books was on reverse mortgages. It was a great kind of introduction to publishing books. And so that's the purpose of this presentation, is to talk about that role for reverse mortgages in retirement income. Now, just briefly in that regard, retirement income planning becomes a matter of solving how are you going to manage these various risks in retirement while trying to fund your different financial goals in retirement. And so we just have to be aware of how these risks differ for retirees, where longevity risk, when you're trying to spend down assets, it's great to live a long time, but it's also more expensive. And so the cost of retirement grows with its length. And then as well, with a longer retirement, just more opportunity for these other risks to manifest and to become a problem as well. And these are the macroeconomic and financial market risks, so investment volatility, but also when you're taking distributions from assets to fund retirement expenses, how the sequence of returns risk plays a bigger role in amplifying the impacts of investment volatility on a retirement income plan, and how so much of retirement income planning for looking to fund a spending goal really involves how can we better manage that sequence of returns risk. And then there's inflation to worry about, even a low inflation rate just eating away at the purchasing power of wealth over time. And then various personal spending shocks or contingencies, healthcare bills, long-term care events, helping adult family members, and so forth, that in part just require additional assets, not earmarked for other purposes, available to cover those types of expenses. And so this is how I view building a retirement income plan, where the 4 L's are the financial goals of retirement on the left: longevity, lifestyle, legacy, and liquidity. And they map into the liabilities or expenses associated with those goals on the right. And then retirement income is about matching assets to those liabilities and thinking beyond just an investment portfolio, between reliable income assets, diversified portfolio, and then reserves as what's available to cover these contingencies, the source of liquidity for the financial plan. Now, the conventional wisdom around the idea of a reverse mortgage and home equity in retirement is that it's this last resort that you treat as a reserve, and then you never necessarily tap into it. So it would ultimately feed into legacy. But if there is some issue that arises in retirement, you could consider a reverse mortgage as a last resort when everything else has gone wrong. And what the research has consistently shown since 2012, with the first articles on this topic published in the Journal of Financial Planning, is that's the least effective way to think about home equity in a retirement income plan. That home equity can fit into this sort of model in various ways, whether it's part of the reliable income with the 10-year payment, whether it's part of the diversified portfolio and coordinating when do you spend from the portfolio and when do you spend from the reverse mortgage. There's a lot more to the story to consider in terms of how to efficiently build home equity into an overall retirement income plan. So when it comes to managing these risks, this combination of longevity and also the volatility, and the volatility that's further enhanced by taking distributions, at the end of the way, there's really just 4 ways to manage these risks. And in this slide, I mentioned the 4 categories, and then also mention how reverse mortgages can start fit into helping these. So the first is to spend conservatively. And that just means use a lower withdrawal rate from the investment portfolio. The lower the spending rate, the less likely you are to outlive those assets in retirement. And so a reverse mortgage could fit into this approach in different ways. It could be the 10-year payment option to turn on this income that will last monthly for as long as the individual remains in the home and eligible for the loan. Even if it exceeded the available line of credit, you would still receive those monthly payments. Or it could be, and this is the most common use for a reverse mortgage, to refinance a traditional mortgage that's being carried into retirement. That having a large fixed mortgage expense in the early retirement years can really amplify that sequence of returns risk, because it means you take a bigger distribution in the early years when you're more vulnerable. Later on, you'll not have to pay that mortgage bill, but if you've already been spending down your portfolio in the meantime, it's the fact that you had that fixed mortgage early on that can create the problem. And you can refinance that into a reverse mortgage. Or another example is building a Social Security delay bridge, where in other presentations and other discussions, not this one so much, but the value in delaying Social Security. But if you're retired and delaying Social Security, you have to use a higher distribution rate until you get to the point where Social Security starts. And that could further enhance the sequence of returns risk. But a reverse mortgage could be used as a way to fund that, so that the Social Security benefits that you're not getting, you could take from the reverse mortgage. And then when the Social Security benefit kicks in with the dramatic increase in what you receive through delay, you're setting yourself up for a better long-term retirement outcome. So the next category, spending flexibly, that's not really a role for reverse mortgages, but if you can cut your spending after a market downturn, that can help manage the sequence of returns risk. And then with reduced volatility, that doesn't mean moving into bonds necessarily. In the investing world, this is where the bucketing or time segmentation strategies would fit. And then also this is where we could talk about annuities. It's not necessarily the place for the reverse mortgage, but when we get to the fourth approach, this is a key place for the reverse mortgage as well, and it's the idea of a buffer asset. So something held outside the investment portfolio that's not correlated with the portfolio, that becomes a temporary spending resource that you can draw from after a market downturn, and that can help avoid selling portfolio assets at a loss and to try to give the portfolio an opportunity to recover before you resume taking distributions from the portfolio. And the reverse mortgage is one of the three buffer assets available, the others being just a pile of cash that I don't think works as effectively, or the cash value of life insurance, especially whole life insurance, but then the reverse mortgage, the home equity conversion mortgage, having a growing line of credit that provides that resource. And this is where most of the research on reverse mortgages is focused, this idea of how can I coordinate? When do I spend from the reverse mortgage and when do I spend from the investment portfolio? So we will talk more about that. Now, before getting into those details, I think it helps to just provide a historical example that just speaks to sequence of returns risk and how it can really manifest and how small changes can have a big impact on portfolio sustainability. And so we have in the retirement world this idea of the 4% rule of thumb, that if you retired in 1966 with a 50 to 75% stock allocation, you could have spent $40,000 from $1 million and sustain that spending for precisely 30 years and then run out at the end of 30 years. So for this example, I'm showing it for 100% S&P 500 investment. There's no 4% rule with 100% stocks. But in this historical scenario, 3.77% was the withdrawal rate that worked. If you retired in 1966 again, taking out $37,700 each year, plus the inflation adjustments, and in 1995, you would have run out. But what this chart is just showing is how a small change to the portfolio distribution rate can help the portfolio. And so the idea would be, well, if you can build a reverse mortgage in to help reduce the expenditure need from the portfolio, the synergies that creates to help preserve the portfolio. So just lowering the withdrawal rate by 20 basis points from 3.77 to 3.57 means you still have more than $1 million at the end of 30 years. With an even further reduction to the 3.37% withdrawal rate, you're going to have over $2 million left at the end of 30 years. And it works the other way as well, that if you increase the withdrawal rate to 3.97, you'd, instead of having the money last through 1995, you're running out in 1991. And then if you further increase the withdrawal rate to 4.17%, you'd be running out of money in around 1988. So small changes in withdrawal rates can have a big impact. And then as well, the same concept could be applied to this buffer asset. Now here we're not showing the buffer asset, but we're just looking at, if I could skip a portfolio distribution, the impact that has on the sustainability of the portfolio. And so the logic and the intuition for what we'll see later is not talking about just skipping a year of retirement spending, but ultimately sourcing that to the reverse mortgage. And so again, with this scenario, if I retired in 1966 and took my distributions every year for the 30 years, I run out of money in 1995. But if I could have just skipped one distribution, so I'm going to take 29 of the 30 distributions, skip one, the implication that has on the portfolio. And the idea is you don't randomly pick which year you skip the distribution. I'm looking at years after a decline in the S&P 500. So the S&P 500 was down by more than 10% in 1966, 1969, 1973, and 1974. And it had its biggest drop in 1974, where it was more than a 20% drop. So if I could just skip taking the distribution in the year, one of these years after the downturn, again, the synergies of sequence risk are such that instead of ending up at zero, I still have more than $800,000, even more than $1.3 million by skipping the distribution in 1975. So again, the intuition will be, well, a reverse mortgage will have costs associated with it, but as long as those costs are less than the synergies created by helping to preserve the investment portfolio, you're going to have a bigger net legacy at the end, because legacy is what's left in your portfolio plus the value of the home minus any loan balance due on the reverse mortgage. And so the gain, if the gains of the portfolio exceed the growth of the loan balance, you've got yourself a better outcome. And that's the intuition for later in the presentation, why you will see a coordinated strategy using a reverse mortgage as a buffer asset can help support a better retirement outcome. Now this slide just amplifies what you saw in the previous slide. What if I could have skipped all 4 of those years of distribution? So what if I had a reverse mortgage with a big enough line of credit to cover 4 of the years of retirement spending? And since it's not taxable distributions, it's proceeds from a loan, you can also, compared to an IRA, wouldn't be able to take out less from the reverse mortgage. But in terms of the impact on the portfolio, by taking 26 of the 30 distributions and skipping the distributions in those 4 years after a market downturn, instead of ending up with zero, I still have $4 million at the end of 30 years. And again, that speaks to the intuition behind, well, there is a cost to the reverse mortgage, but as long as the cost is less than $4 million, you're going to have a better net outcome, net of the cost, because of the synergies created to preserve the investment portfolio. And when markets kept going up, this was all more of an abstract discussion, but for somebody who's retired in 2020, taking the distribution from the reverse mortgage rather than from a declining portfolio balance can help to put on this sort of trajectory towards helping to preserve the portfolio and creating those synergies and helping to manage that sequence of returns risk for the retirement. So now getting more into the reverse mortgages, there's a number of different ways they can be used. So this is the spectrum of potential uses. And I group these into 4 general categories. And the categories range from, on the top, uses where you're more likely to use the line of credit faster and sooner rather than later. And that would be using the reverse mortgage to coordinate with housing debt in retirement, either to refinance an existing mortgage or what I call transition from a traditional mortgage to a reverse mortgage. And what I mean there is you make the shift, you refinance the traditional mortgage into the reverse mortgage, and you don't have to make payments to reduce the loan balance on the reverse mortgage. But with this strategy, you voluntarily continue to make the mortgage, what would have been the same as the mortgage payments, to pay down the loan balance. But you only do that in years when the portfolio has been growing. That, just like with that buffer asset example, after any year where the portfolio had a negative return, you would just, because those were voluntary payments, you skip them. And so you help reduce that distribution need from the portfolio at key points there. You could also fund the renovations to the home to allow for aging in place. And as Shelley mentioned, kind of one of the implications of the global pandemic is just a new look at institutional living and whether people might increasingly prefer to age in place as an alternative to that. Well, there can be expensive renovations needed to build a wheelchair accessible entrance or to put in a bathing facility or a bedroom on the first floor of the home, these sorts of things to allow for aging in place. And that could be funded through a reverse mortgage. And then the HECM for Purchase program is also a way to help finance the purchase of a new home through a reverse mortgage. So moving along the list, next is the portfolio coordination for retirement spending. And this is where most of the research is focused, as I mentioned, this idea of using the reverse mortgage as a buffer asset in some way to coordinate with distributions from the portfolio. And so there's different ways that can be done. The third category is a funding source for retirement efficiency improvements. So much of building efficient retirement income plans involves creating a short-term expense that will help to create a bigger long-term benefit. And the reverse mortgage can be a way to fund those short-term expenses to lay that foundation for a better long-term outcome. So whether that involves buying an annuity and a reverse mortgage 10-year payment can be an alternative there, whether that is building the Social Security delay bridge to get that efficiency improvement through Social Security delay, whether it's the tax bracket management. And another interesting use for a reverse mortgage right now is this could be a great time to do strategic Roth conversions. When the IRA account balances are down, you can generate less taxable income on the Roth conversion, and you pay the taxes potentially in a lower tax bracket that way. Now, it's problematic if you have to pay those taxes from an asset that's also declined in value. The reverse mortgage can be a resource to pay those taxes on the Roth conversions. Or just more generally, whenever it looks like you're stepping up into a higher tax bracket, or you're generating that adjusted gross income that could trigger more of the Social Security tax torpedo or the higher Medicare premiums, you just put a stop on taking the distribution from the assets that generate income that goes into adjusted gross income. You could draw from the reverse mortgage, have more spending power without triggering all the side effects associated with generating more taxable income. And then one final category here is for people who do have long-term care insurance and are finding that the premium increases keep happening. Rather than lapsing those policies, a reverse mortgage could be a way to help continue to make those payments on the existing policies. And then the final category involves setting up a reverse mortgage and potentially never using it, but it's effectively an insurance policy where the insurance premium is just the upfront cost to set up the reverse mortgage, and then the benefits it can provide. If any of these things happen into retirement, it can provide that growing source of funds to help cover these types of events. So if you deplete the investment portfolio, you have that reverse mortgage with a growing line of credit to fund spending. If you open the reverse mortgage and then the home declines in value, the reverse mortgage becomes a protective hedge because it's a non-recourse loan. So if you're able to borrow more than the home is worth, that reduces the ultimate loan balance that would need to be paid. And then it can also just provide a contingency fund for various spending shocks, funding in-home care so that you don't have to move to an institution, funding big healthcare bills. And there's some interesting uses as well with divorce settlements where a reverse mortgage can help to either allow one of those ex-spouses to stay in the home and then use the reverse mortgage to free up potentially half of the home equity to go to the other spouse, or to otherwise sell that marital home. Each spouse gets half of the home value, and then with a HECM for Purchase, assuming this is part of a responsible retirement income plan, each ex-spouse could then purchase a similarly priced home. So in terms of understanding how reverse mortgages work, there's various issues to start with that reverse mortgages have had a negative image in the past. Some of that's related to misconceptions, such as there's always been this idea out there that people lose the title to their home if they use a home equity conversion mortgage, and that's just simply never been the case. And then some of the negative media stories about reverse mortgages tend to center on family misunderstandings. They're written from the perspective of a child who believed they were going to receive the home as an inheritance and then found out that their parents decided to use home equity to help fund their own retirement rather than leave it as an inheritance. And so it's the stories don't provide the complete picture. They're just from the perspective of, hey, I thought I was going to get an inheritance and the reverse mortgage took it away from me. So that's of course not the full story of what's going on in those circumstances. That home equity was owned by the people who decided to use it to fund their retirements. Now, other issues that have existed but have been addressed through public policy include there are now financial assessments that, and this is less relevant for financial planning clients, but another problem with reverse mortgages in the past was just people do use it as a last resort. And then eventually they're kicking the can down the road, but at some point they're not going to be able to sustain that retirement. And so it can lead to foreclosure if you're not able to pay your property taxes and so forth. So that's been a source of negative media stories that's been addressed through financial assessments. There's now also protections for spouses who are under age 62 at the time the loan is taken out so that they're protected to be able to stay in the home. Taxpayer risk through the mortgage insurance fund has been addressed through adjustments to the premiums to fund the mortgage insurance and the benefits that mortgage insurance provides, such as that non-recourse aspect, where the household is not on the hook to pay back more than the home, the appraised value, 95% of the appraised value at the home when the time the loan balance becomes due. And as well, there's limits on how much home equity can be tapped to avoid just depleting the home equity for questionable uses with the reverse mortgage. Now, issues that remain include stigmas about using debt in retirement, the psychological aspect of once I paid down a mortgage, I feel like I shouldn't create a new mortgage on the home. And that's always going to be an issue to overcome, as well as the direct-to-consumer TV commercials don't help matters either. Some of the companies do use the kind of call-in direct-to-consumer using the celebrity like Tom Selleck recently and Henry Winkler, Alex Trebek, and in the past Fred Thompson and people like that doing these commercials that don't just seem to be the whole story and maybe give people a bad feeling about the reverse mortgage. And that being said, and let me go quicker through this part so we can just see more about how it all fits into the plan. So to be eligible, you've got to be 62 or older. You have to have equity in the home. You can have the mortgage on the home, but it has to be fully paid off as a part of opening the reverse mortgage. And part of that could just be refinancing the mortgage into the reverse mortgage. You do have to have the financial resources to cover property taxes, homeowners insurance, and home maintenance. You have to have a counseling session with an FHA approved counselor. You have to have an FHA home appraisal. It does have to be the primary residence. And there's a lending limit this year of $765,600 on the value of the home. So a home can be worth more than that, but the reverse mortgage would only apply to that value of the home. And that can create an issue for people who do have higher valued homes with bigger mortgages on them. They might not be able to cover the full mortgage balance through the reverse mortgage because this lending limit on what portion of the home the reverse mortgage can apply to. For people in their 60s, you're not really going to be looking at getting more than $300,000 to $400,000, say, through the line of credit. So if an existing mortgage balance is greater than that, it could be an issue. So this is a part, let's kind of go quicker through this. And so I do want to focus on the intuition about the growing line of credit, but we don't have to dig into all these details today about exactly how the initial line of credit is determined and how it grows over time. Just to kind of get more to the punchline, you do figure out an interest rate to determine the initial borrowing capacity, and then the line of credit is only available with a variable rate home equity conversion mortgage, and the effective rate is that ongoing variable rate of interest. So these involve a lender's margin, an interest rate, and then also with the effective rate, an ongoing mortgage insurance premium. Let me again just go, all this is also covered in my book if you want to dig in, but it can be hard to get all these details in a relatively short presentation. So it is worth addressing this slide though, which is looking at the initial borrowing capacity, the principal limit factor. That's the percentage of the home value up to that $765,600 limit that you can access through the reverse mortgage. And that percentage is related to age and interest rates. And it's really a present value calculation. So the older you are, the more borrowing capacity you can get because less time for any sort of loan to grow and be backed as collateral for the value of the home. And then also interestingly, with lower interest rates, you have the higher initial borrowing capacity. Well, that's just because the present value is higher with a lower interest rate. And you can see how interest rates are really more important than age in terms of if interest rates increase a little bit, you can see how far to the right you have to travel with age where you get back to the same principal limit factor again. So the 3% expected rate that you see here, with interest rates right now at unbelievably historic lows, that's going to be closer to the kind of interest rate we're going to be talking about at the current environment. And that is a higher borrowing capacity initially. Now, in terms of understanding the line of credit growth, the principal limit is always equal to this equation. It's equal to the loan balance plus the line of credit plus the set-asides are for individuals who may not have the resources to cover their property taxes and so forth, can have part of the line of credit carved out to cover that. Not necessarily relevant for financial planning clients. So we can really just simplify this to say principal limit is loan balance plus line of credit. And this pie, it's always going to have the same ratio if I'm not either borrowing or voluntarily repaying. All that pie is going to grow at the same variable rate of interest over time. Now, if I borrowed fully from the reverse mortgage, it would be the loan balance that grows over time. And I think the intuition is clear about, well, of course, if you borrow, you're going to have a growing loan balance with interest. Well, the interesting planning implication of the reverse mortgage that opened up this whole avenue of the line of credit growth concept is, and this may not have been the intention of policymakers, but if I open the reverse mortgage and I don't borrow from it, well, to be clear, you do have to keep a minimal loan balance to keep the line of credit open. So very small loan balance, but otherwise 99% of it is line of credit. That line of credit's growing at the same rate that the loan balance would have been growing. And that can be very powerful and speak to the value of opening the line of credit sooner rather than later. So here's an example of what this looks like we have the purple curve as the value of the home over time, starting at $250,000. The yellow curve is the borrowing capacity if I wait to open the line of credit. So assuming interest rates don't change in this chart, but as I get older, I get a higher percentage due to the age, and also the home is growing in value. So the dollar amount that I can get increases if I wait to open the reverse mortgage. But the point is, if I open at 62 and let the line of credit grow, and that's that cyan colored curve, it grows faster than if I wait. And that's generally going to be the case. The only way you could really beat that is if you just get such huge home appreciation that it could somehow offset these factors. But otherwise, the line of credit's going to grow faster by opening it sooner rather than later. Now, admittedly, it's not super impressive looking in this chart, but consider with us being at these very low interest rates, what's the impact of interest rates increasing in the future? Well, here's just the example where sometime within the first year, interest rates just permanently increase by 1%. Well, then that's going to reduce the yellow curve in the future, because with a higher interest rate, you have a lower principal limit factor if you wait. But if you already open the line of credit, you don't have to worry about, you've already got the initial line of credit set, and now it's just what is the growth rate on that line of credit. And now that line of credit will grow faster because the interest rates are higher. And there you can see a much bigger differential developing between opening it sooner and waiting. And you can even see in this particular example that at about age 88 there, the line of credit grows to exceed the value of the home. And that's even with that home appreciation going on. So that's where that capacity of the non-recourse loan comes into play. Either if it was borrowing, the loan balance will not exceed that home value, or if you waited and you have line of credit available, you can tap into that without generating a net impact on legacy because the repayment's already been capped with the home value there. So interest rates are at historic lows at this point, and there's only one tool I'm aware of that actually benefits from low interest rates. Everything else becomes more expensive. And there's some tools that are relatively better off with low interest rates, such as delaying Social Security and also annuities. But the reverse mortgage is the one tool it's not just relatively better off, it's absolutely, in absolute dollar terms, better off. And that's because with lower interest rates, since it is a present value calculation, you're getting a larger initial principal limit factor. And then, so this is something people aren't talking about this as much anymore, but to the extent that you think interest rates might increase again at some point, then if you're holding that line of credit, you're talking about faster line of credit growth in the future as well. Now, when it comes to the spending options, you have these options with taking out an initial lump sum, turning on a 10-year payment for life or for as long as you live in the home and remain eligible, a term payment for a fixed number of months and years, and then also the line of credit. And you can choose various combinations because a line of credit is completely flexible about when you want to draw from it. And you could call each draw a type of lump sum distribution. So now to talk about the research behind these different uses. And the first is just, if I carry a mortgage into retirement, what's the impact of carrying that mortgage into retirement? And might it be worthwhile to consider refinancing that into a reverse mortgage? So there's a case study here on this, that a 65-year-old couple entering into retirement. 20 years ago, they purchased a $300,000 home. And then this is 20 years ago, like 30-year fixed rate mortgage at 7.5%. Now, 5 years ago, they refinanced into a 3.5% fixed 15-year mortgage. So that brings us to today, where they have annual mortgage payments of $15,574. They have 10 years left on that 15-year mortgage, and their remaining mortgage balance at this point is $129,526. Now, over the past 20 years, their home's appreciated at an average of 3%. So it's worth $541,833 today. Based on the interest rates I'm looking at in the example, the principal limit factor is 45.9%, or of the home value, or $248,701. Now, this is where there can be some sticker shock, and this is, I'm going to assume the full upfront costs to just demonstrate or to see, will the benefits exceed the costs? So to set up this reverse mortgage, they're looking at a $6,000 origination fee. And then the kicker is this 2% mortgage insurance premium. So 2% of the home value is a mortgage insurance premium of the $10,837. And then I use $2,500 to approximate other mortgage closing costs. And so $19,337 is the upfront cost to set up the reverse mortgage. And they're, instead of paying for that out of pocket, they're going to finance that into the loan balance. Plus, they have to fully refinance that mortgage balance of $129,000. So when you add those together, they're financing around $150,000 in the reverse mortgage, leaving them just under $100,000 for line of credit. And then what I'll have them do with that line of credit is they'll let that grow. And if at any point they deplete their investment portfolio later in retirement, then they'll spend from the line of credit until it's depleted as well. And at that point, they would trigger failure where they can no longer fund their retirement spending plan. So let's look at the probability of being able to fund these types of retirements for up to 40 years. And what we're looking at here is probabilities of success over time to fund a 4% post-tax and post mortgage payment withdrawal rate. So they have $1 million IRA. They want to spend $40,000 after paying taxes. So they have to pay taxes on their IRA distribution. And then they're also, if they carry the mortgage into retirement, they have to also pay that mortgage payment and also taxes on what they need to make that mortgage payment. And I suppose they live in Pennsylvania, so 22% federal and 3% state tax gets them to a 25% marginal tax rate. So the strategy that supports the highest probabilities of success over time is to refinance the mortgage into the reverse mortgage and then use voluntary repayments so that you're continuing to make mortgage payments in years to reduce the loan balance and to reposition that asset into the line of credit. So you then have line of credit growth instead of loan balance growth to help you later in retirement as well. That making those voluntary repayments comes out in first place. Slightly behind it is refinancing the mortgage into the reverse mortgage and never making a voluntary payment. You just let it ride and you use that line of credit in the same way where, again, if the portfolio depletes, then you draw from the line of credit. Those both do noticeably better than either paying off the mortgage so the next 10 years of retirement, you have that bigger fixed expense, and then you don't consider the reverse mortgage until you deplete your investment portfolio. And then at that point, you open the reverse mortgage and start to spend from it. And then once you've tapped that line of credit, then you've run out of spending tools and you would trigger the failure. Or so with the pay off the mortgage, you just decide to take that out of your IRA at the start of retirement. And with the keep mortgage, I might have just misstated that, but with keeping the mortgage for those first 10 years, you're making the mortgage payments. Both of those strategies do noticeably worse. Now the next slide adds 2 other strategies, which just shows about how there is this great value in line of credit growth in terms of the 2 strategies I'm adding look very similar to refinancing the mortgage into the reverse mortgage. And that's one of them is you pay off the mortgage from the IRA and then you immediately open the line of credit and let it start growing. So that line of credit growth, opening it sooner rather than later, really creates a lot more capacity to use later in retirement for spending. Or you could keep the mortgage. So for the 10 years, you have to pay the mortgage payments. And then at the end of year 10, you've now paid off the mortgage. Then you open the line of credit 10 years into retirement. And those both do very similar to any sort of direct mortgage refinancing strategy. And they're all dramatically better, again, than the strategies that would just treat a reverse mortgage as a last resort. Now, in terms of legacy, there's not negative impacts from the reverse mortgage. In fact, you can see slight benefits for the most part. This is at the median, so in the average outcome, the strategies that refinance the mortgage are giving you a little more legacy power, not less, to be clear, and not dramatically more, but it's not hurting legacy. And then what you see in about year 34 is those strategies that open the reverse mortgage sooner get flat for a while, and instead of initially triggering a negative legacy, which the negative legacy is just your shortfall relative to your spending goal. How much did you not be able to fund of your spending goal over time? Well, that's the non-recourse aspect at work, where you still have line of credit, so you can still cover your spending, but it's not creating a negative legacy because you're now tapping into the part of the line of credit that exceeds the value of the home, so it's not having a negative impact on legacy. But eventually that runs out, and then you can see going towards year 36 and beyond a negative legacy as well, but you're way ahead of either of those last resort style strategies. Now, I won't go into detail about this, but there's a HECM for purchase example that works in a very similar way, where we just are looking at a couple that want to purchase a new home. And they can do that by either paying cash for the home, taking out a traditional 15-year fixed rate mortgage, or funding it through a reverse mortgage, funding about half of the home, well, 45.9% of the home value. And then you also would have to account for the fees, but from the reverse mortgage, and then the rest from their investments. And not going through all the details here, but to get just the punchline about this, because it's a similar kind of story, the strategy coming out of on top is the HECM for purchase, and then making the voluntary payments to reduce the loan balance over time. Strategy coming in second place would be to take out a 15-year mortgage, but then at the end of 15 years, open the line of credit so it can start to grow. And you can see that the worst strategy coming out here would be to just pay cash for the home and treat the reverse mortgage as a last resort. And the second from worse would be to take the 15-year mortgage and then treat the reverse mortgage still as just a last resort after the portfolio depletes. So portfolio coordination for retirement spending, this is where most of the research is focused. And so in 2012, we had these two different articles published in the Journal of Financial Planning. They didn't know about each other's work, but they really drew a similar conclusion. And so with the two articles, the conclusion both articles reached was strategic use of a reverse mortgage standby line of credit can create retirement income efficiencies through its contribution in managing sequence of returns risk in retirement. And they both set it up in different ways. The Sachs and Sachs version looked at that approach where if there was a negative portfolio return in the previous year, spend from the reverse mortgage in this year, and they didn't have any sort of voluntary repayments if markets recover. And then the Salter, Pfeiffer, and Avinsky approach, they were all through Texas Tech University. They looked at a capital needs analysis of, to meet your spending goals, how much wealth did you need to have each year in retirement as you spend down your assets with a fixed rate of return. And then if you ever fell below 80% of that threshold, they'd have you tap into the reverse mortgage to cover that year's expenses. Otherwise, you fund from the portfolio. And if you subsequently recover and exceed that threshold, then you start making voluntary payments to reduce the loan balance and to add more back into the line of credit for later use. So I replicated the research they did and then also looked at other various strategies as well and updated this. It was important that the reason I have this second edition of the book was a big rule change in October 2017. So fully updated for the current system. And what comes out of this is today, this was different before October 2017, but today the two coordinated strategies come out on top. That there really is value to that buffer asset approach to create that line of credit and to have that coordinated line of credit. And then the strategy that comes out of this looking the worst is the last resort option for home equity, where you just leave it and you're only going to use it in the event that the portfolio depletes. That of the 6 strategies here, that last resort is dramatically worse than the others. And then you have flexibility in the different options for how you're otherwise going to use the reverse mortgage to coordinate with spending. And then as well with legacy, this is looking at the average median outcome. And you're not seeing big differences again, but you are seeing the coordinating strategy in the long term coming out on top. Now in the median, you don't deplete your investment portfolio until later into retirement. And that's why the last resort comes out ahead of use home equity last for quite a while. It's because if you use home equity last, it means you open the line of credit at the start of retirement. So you had to pay that upfront cost. And then until you deplete your investment portfolio, you don't actually use the line of credit. So the use home equity the last resort saved you the upfront costs. But eventually, with a longer retirement, it comes out the worst because it's giving you the least amount of protection to fund long-term expenses. And the buffer asset approach doesn't have you wait till your portfolio depletes. You're strategically using throughout, and that's how it's coming out ahead. And you can see those two coordinated strategies after about 20 years into retirement. They're supporting higher legacy values than the average outcome. So key takeaways from all this: conventional wisdom hurts retirement sustainability. The home equity conversion mortgage shouldn't be the last resort option. That conventional wisdom is really the least effective way to approach it. Strategic HECM use can improve retirement sustainability and help support a larger legacy. It works because of its role in managing that sequence of returns risk, which is why I spent time talking about the intuition of that at the beginning. Effectively, the gains to the portfolio in managing that risk exceed the cost of the reverse mortgage. And also having that growing line of credit is really powerful. The low interest rate environment favors the HECM program, home equity conversion mortgage, unlike any other retirement income strategy. And this is a strategy that really benefits the middle class. I mean, it can help higher net worth people as well, but to the extent that you have the limit on the home value, that's a factor. And there's, in general, the ratio of the portfolio size to the home value matters. And the higher the home value relative to the amount of investment assets, the greater the relative benefit is of having the reverse mortgage in place. So responsible use of a HECM, home equity conversion mortgage, can improve retirement income efficiency.